Hi guys, welcome to another episode of Finance Talk, where we speak about finance, business, and investing. I'm Eugene. I have more than 10 years of experience in business. I also interested in finance and building my own portfolio and hoping to set up a fund in the nearest future.
And I'm Nick Rational. I too have a lot of business experience and been doing the investing for a while now. Together, we're going to share with you what we have learned, and together we can all learn more and become greater investors. I too hope to start a fund in the near future, and let's all learn together.
So, what will be our today's topic, Nick?
So today we're going to continue with the topic of what makes a CEO a good capital allocator, because they are managing our money, our company, and we want to make sure that they are doing things that we approve of. In the last episode, we discussed two of the things they can do with the money, which is pay off the debt, pay us in dividends. Let's start off with the next one, which is buybacks. Just briefly, how buybacks work is that they use the money to buy out people who want to sell their shares, and they destroy those shares, thereby increasing the percentage of the business that you now own. And to explain it in a more clear way, let's imagine that you bought a bar, a place where people drink, with two of your friends. So each of you have a 33 1/3 share. So each of you have shares in the business. The profits of the business come in, and that can be spent on various things, staff, maintenance, all that kind of thing. But the free cash flow, the money that is profit at the end of the day, that's what needs to get allocated. They could pay you into your bank account, that's dividends. They could pay off the debt of the bar, which increases the value of the bar you own. Now, this third option is the buyback. So before paying any of you, you can take that money and give it to one of the partners to get rid of them. That's their big buyback. And when they disappear, now you own 50% of the bar. And that's effectively what buybacks are. It increases your percentage of the business using that free cash flow to get rid of other owners of the business. So I like this one a lot. If you buy a business that does a lot of buybacks, you might have started off owning a certain percentage of the business, and 10 years later, now you own maybe double, triple, 10 times more of the business, percentage-wise, and that directly, is a massive growth of the value of your investment. What are your thoughts on buybacks?
I also very love this stuff with the buybacks, and I think that this is really clever strategy in order to improve and increase the percentage for every shareholder. And personally, I look for companies not only with growth and low debt, but companies who constantly buy back their shares, because can be your, I would say, a risk insurance. Because if the company would not grow and it will still buy back its shares, you will still have the increase in the stock price, because the amount of stocks which are sold on the stock exchange will decrease. The same volume on the buying and selling the stock will inevitably increase the price. So personally, for me, this is one of the interesting indicator, and it really shows how well the management operates in the company.
That's an excellent way of looking at it. I didn't really look at it that way before, that there's less shares and therefore the demand will increase and therefore the share price will increase. That is really, really cool to think about. I like that a lot. My final thoughts on buybacks is just like when you look at the previous two that we talked about in the previous episode, you know that they are making a good investment if they are lowering the debt, if the debt is a higher percentage than what they could grow your money otherwise. If they could have grown the money higher than the debt percentage of interest, then maybe they should have done that. So you can tell if they're a good investor with that, allocating your money. And then likewise with dividends, to me, usually that indicates that they can't grow your money. Now with buybacks, whether they're a good allocator or not, comes down to what is the price that they're buying back those shares. So if the shares are overpriced, they're effectively destroying your capital. It would be like someone forcing you to buy the company when the company is maybe being sold for double the actual value, or forcing you to buy a house that's double the value of what it should be. You want them to be buying it on a sale, on a discount, the same way that you would buy the shares. And that's a good capital allocator when they do buybacks when the shares are undervalued. What do you think of that?
Yeah, this is a really great point. And I personally look at three indicators here. So first of all is the return on assets, return on equity, and return on invested capital. And the third one, I think, shows how well the management of the company reinvests your money. Usually you can go to annual or quarterly report and see what will be the buyback strategy. And usually the management will write you that we will buy approximately 2 million shares, or we will start our purchase program from now till 2025, for example. And you can easily calculate what will be the price of buying back shares. And using value investors technique and evaluation techniques, you can assume how they manage and how well they buy back their shares, as you said previously.
That brings us on to the fourth way that they can allocate money. This is a more complicated option because there are sort of sub options here. The category is growth. And so just like they can pay off debts to grow your value, or they can buy back shares to grow your value, this one is to grow the actual company, which grows your value, and when they can put money towards that. And there's a couple of different ways that they can do this. One of which is to put the money into research and development. So that would be to expand their product line, thereby expanding their bottom line. I would consider research and development to be one of the growth options, but also mergers and acquisitions. When they buy another company, if they are doing a good job with the allocation, it'll improve the return on invested capital. But if they do a bad job in their purchase, it'll destroy value. And so that's something to look into. I would say that, if they're putting massive extra money into marketing or buying assets that are increasing your book value, that can also be a value add. So anything that grows the actual value of your company would fall under growth, and it is one of the four that we have discussed so far. It's the fourth one, I should say. What are your thoughts on the growth option?
I would like to add that you can go to different statements like income statement and cash flow statement in order to understand how much money does the company spend on research and development, capex, and all this stuff. And actually, you can go further and compare those numbers with the industry average and with competitors. And by doing that, you will pretty much understand what is the average number for marketing spending or capex for this industry and who is the better in this field. So probably when you start analyzing one company, you can find another company which is much better by chance. And probably this company can be your final investment.
So we will dig into CapEx or capital expenditure in a future episode in more detail to look at the split between maintenance and growth and how you determine that and how you determine it if it's very hard to do. So that's a whole other episode. The four people allocate money that we're paying a lot of attention to. There is a fifth way which people don't really consider, but it is something to consider, and that is when they don't do one of those four with your capital and they let it sit and pool and grow. It's considered a cash position or a war chest of money, and some companies just let that grow really big. Obviously, that money has to eventually go to one of the four, but in even the medium term, they can sit on it for 5 years or even a decade. Sitting in a cash position is a way of allocating money, and you must determine, are they being smart about it and protecting themselves against unexpected catastrophes? Are they being smart and waiting for the right opportunity for an acquisition? Or are they wasting your capital because inflation eats into that capital's spending power over time? And so that is a fifth way of allocating, is to sit on a cash position, and it is something to consider. Are they doing a good job with allocating it that way? That's the fifth and final one. What are your final thoughts on that?
I agree that this is one of the most important indicators as well. This number can depend on the industry. For example, if you are a software company, you probably need some money on the balance accounts like Apple in order to acquire companies because you need to be at the edge of the competition. And this is the rapidly growth and changing environment. But if we speak about, for example, home building or funeral homes or other classical and just ordinary businesses, not so many times you will need this sum on the balance accounts. So if you can see that in these ordinary and standard businesses, the management still has the money on the accounts and it doesn't do any acquisitions or unexpected purchases, probably you can assume that they can waste your money and you won't receive the higher percentage of return on your invested capital. So that's all for today. Thank you for being with us. If you have any questions, please write them down in the comments below. We also have the community in Discord. The link will be in the description as well, where you can join and there you can find different information about the books, articles, stock picks, and ideas. See you next time.